It's interesting. Before we got started, it's been quite a week already.
I'm exhausted. Trying to catch my breath coming into the studio. We had a record day on Tuesday. The pipes are flowing in investment grade credit.
Why?
Why?
Well, why in this environment?
I think this was well telegraphed. So investors were ready for this. If you look at the demand for the Amazon deal, how many times over was it subscribed? Yesterday, we had Salesforce. Again, oversubscribed. Everyone was waiting for this. I think everything else that's been going on, whether it's AI, private credit, high yields, et cetera, the war, that's all still going around, but the pipes are flowing.
Why is, though, investors, the comfort with all of this? I thought, Salesforce was kind of an interesting thing, and this was to fund a share buyback. Was that the problem? Because I know when that headline crossed, when they were initially going to say that, we were like, what? This is what they're doing? Is it
because it's Salesforce and it's seen as susceptible to AI disruption?
Yeah.
I don't know.
How are investors kind of weeding through?
I think if you look at their business model, folks are concerned, right? The share price is down. It's down by, 30-40% from its highs. Like you said, share buyback, when you look at the leverage, the statistics, the credit metrics that we look at, doesn't look that bad. And then when you factor in the valuation that they printed at yesterday, it was coming at BBB minus levels. We have bonds in the market that much lower credit quality. This is single A rated today. Single A rated today, maybe it gets downgraded a few years in the future, but it's trading today as if it was already downgraded.
All right. So are you seeing any stress within the credit markets and the debt markets?
So the pockets of stress that we're seeing, again, I'm going to put the war aside because that's still fresh. Certainly BDCs, right? Business development companies, private credit. Can't turn on your Bloomberg terminal without seeing another headline of another fund seeing redemptions. That's certainly an area that we're very focused on and thinking about. Is there spillover? Is there spillover into CLOs, for example? Broadly syndicated loans, those go into CLOs. 2/3 of CLOs own that broad market. We're watching that very closely.
At what point would you be watching it and say, okay, yes, this is the official moment that there is spillover? What would you see that would cause you to say that?
So the redemptions that we're seeing in BDCs are one thing. Those are meant to be typically long-term investments where there are investors going in know that this is committed capital.
Yeah.
I think when you start to see the publicly traded instruments, high-yield bonds, high-yield leverage loans that are more in the public market, even though some of those companies may be private, that they were LBO'd.
Yeah.
When you start seeing large redemptions and liquidity events, that's when you say, oh, that's going to spill over, and that's going to become a bigger problem for the credit markets.
Jason, if we start to see, if we continue to see rates kind of stay where they are, even potentially trend higher, I do think about the rate environment a lot, right? This is what we've talked about with private credit, that deals done in a low rate environment look good. And then, of course, when rates go higher, not so much. But if that rate environment, we continue to see rate pressures, do we start to see maybe more cracks emerge?
Yes and no. So the lower quality part of the cohort, those borrowers that really don't have a lot of cash flow, could be more susceptible. But I also think, why are rates higher? Are they higher because of oil and what's going on with Iran?
Yeah.
Or are they higher because we're in a growth environment? If growth is GDP is growing at 2-3% this year, I think these companies are fine. And what we're seeing, back to your question before, why so much demand? Yield. Yield is pulling in capital. Last Monday, so a week and a half ago, right after the war broke out, it was a nothing event. We call it a nothing burger. A nothing burger because spreads widened 5 basis points in investment grade. Yields were higher. It got bought. Monday was a day of discipline. It wasn't a day of opportunity.
So, go ahead, Carol. You were talking a little bit about how things have changed in the last few days. And if we think about the effect on consumers, the effect on the economy, I wonder how higher energy prices, gas prices up to $3.60 a gallon nationally average, up from $3 just a little more than a week ago. Heating oil hitting $5 a gallon. If that hits consumers, what does that do to the U.S. economy?
It's the duration. How long does this last? It's going to hit consumers. It's already, my 82-year-old mother is asking me the same question. How long is my gasoline prices or my food prices going to be?
What did you tell her?
Higher? I said, well, let's see how long this lasts. If we have resolution in a few weeks, okay, that may not hurt you. But also keep in mind, we have seasonality to oil and gasoline. There's a summer blend.
Right.
Typically, we go higher as we go into the summer anyway. Question is the duration. How long does this last? How quickly can we get resolution? We had the discussion earlier this week about the duration, the impact of oil prices. We're certainly not making a prediction on the duration of what's going on in the Middle East, but certainly thinking about the strategic reserves and the release, it doesn't really unclog the situation in terms of prices.
Right.
It's not enough. It's only a handful of days worth of supply, and that's not going to, in our minds, reduce the price.
It gets back to the big question. Our last guest said best case 6 weeks, worst case 3 to 4 months. That was his view. Do you have a best and worst case when you think about this environment and how long this goes on?
We're not that good to on the politics side to say it's going to be in this time frame. What we can do is to stress test and say these are the sectors. The consumer is going to be under pressure. We know. Let's be careful, confident, re-underwrite our credits, our borrowers that we own.
Yeah.
And if it goes on longer, who's next? So we know where the bullseye is, the center of the fallout. But let's think about the second and third order magnitudes.
I am also curious, we had a story that said how U.S. borrowers, in fact, are rushing to take advantage of the still open capital markets before things potentially turn worse should the war escalate and oil prices increase further. Again, it's like the time we have to figure this out. Are you seeing that again? Like I think about what happened in the last week or so, or just even this week about issues coming to market. Are you continuing to see that or expect that? Where it's
the lowest quality part of the credit markets where there's some pause. So think low single Bs, triple Cs. Those were companies that probably needed to restructure anyway. I think when you look at the broadly syndicated loans, leverage loans, or even private credit, those are companies that tend to be smaller. Do they need access to capital? Not today. And we haven't talked about software. How about the software sector? Where does that spill over?
Okay, perfect segue. That's exactly what I want to talk about. Salesforce drawing that tepid demand for a $25 billion bond sale, perhaps lingering worries over the software sector's exposure to AI. How do you view how vulnerable that entire sector is to just how quickly things are moving forward when it comes to this tech?
You just said it. How quickly? So does it become an issue in months or years?
I mean, the development of this is so quick. Yeah. It's mind-blowing.
That's right. And there are stories, there's research out there talking about default rates at 15%. One of your colleagues had on earlier the CEO of Hamilton Lane. And I thought what he said was really interesting. 15% default rates is eye-opening. Is that cumulative or is it all in 1 year? Right? Does it happen instantaneously or does this happen over several years?
Right.
Think back to the financial crisis, the high-yield market. We had default rates peak in November of 2009, right? So even after we said there was the bottom in the market, that was less than 15%. So we're calling for, does it happen all at once? We don't think so. Does it happen cumulatively over time? It's too early to say. And then we think about the maturity profiles of those companies that may be in the center of the software bullseye. Those maturities are 2028, 29, 30. Why would they come to the market today when investors are running for the hills and making redemptions? Maybe they can wait till 2027 or 28 to address those maturities when we have more information.
So what's your advice to investors in this environment? Our last guest was more like, play it safe, more cash, like be careful. And that was certainly talking about from the equity side and some different. How do you guys see it from the debt markets?
Yeah, so I would call it as this. We want to be nimble, meaning that you have liquidity. You want to nibble, but don't feast. This is not an environment when you look at broad index spreads, they're not screaming cheap. We're still at generational tights, 30-year tights in a lot of parts of the market, whether it's IG, high yield. I think you want to be really selective, and I think you want to trade this market. This isn't one where we want to buy a 30-year fill in the blank from the last week or two of new issuance and hold it for 30 years. We're gonna take that concession, bonds that come cheap, let the spreads compress, sell them, and reload when there's a better opportunity.